Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're explaining what you need to know about rolling over your 401k in 2023. Make the wrong decision, and you could end up losing a lot of money in the rollover process.
That's exactly right. You have four choices when it comes to what you can do with an old 401k after you've left your job. You can roll over to your new 401k. You can roll over to an IRA. You can cash it out, or you can leave it where it is. And in some cases, especially if you're between the ages of 55 and 59 and a half, it might make the most sense to leave it right where it's at. I'll get to that a little bit later in the video, but for now, let's start with making sure you choose the right type of rollover, one that doesn't cost you in taxes and penalties.
All right, so let's get to it then. For those looking to roll over their old 401k in the next few months, what do people need to know?
I want to start with the most important thing people need to understand, and that is that the amount of taxes you pay on a 401k rollover boils down to the type of 401k rollover that you actually do.
Yeah.
I'm bringing this up first because in my 25 years as a financial advisor, I've seen people think they're doing the right thing by rolling over their 401k only to get smacked with a boatload of taxes, in some cases, penalties.
Penalties. Yep, absolutely. All right, so the types of rollovers are indirect and direct. Let's start with indirect because this is the one that's a little trickier and also can cost you a lot of money.
With this type of 401k rollover, you actually receive a distribution from your retirement plan, meaning that money comes to you. And then you have to make a deposit into the new retirement plan that you want to roll it over into to complete the transaction.
Okay.
You can make a rollover at any age, but there are some specific rules that must be followed. First one is you must complete that rollover within 60 calendar days of the date the funds are paid from the distributing plan.
Calendar days.
Calendar days. Remember that one.
Yeah.
Not business days.
Yeah.
Also, you can only make one indirect rollover per every 12-month period. And if it's completed properly, indirect rollovers aren't subject to income tax. But if you fail to complete the rollover or you miss that 60-day deadline, all or part of your distribution may be taxed and subject to a 10% early distribution penalty unless you're age 59 and a half or another exception applies.
Okay.
Indirect rollovers, Michelle, catch a lot of people by surprise because if you go this route and you have the money sent to you, your employer must withhold 20% of that payment for income taxes. After taxes are taken out, you're going to be sent the remaining funds by check.
Okay, so this means that if you want to roll over your entire distribution, so you don't get penalized, you're going to have to come up with that extra 20% from somewhere else?
Yeah, that's correct. You have to come up with that extra 20% to make the full rollover amount, but you're able to recover that from the withheld taxes when you file your tax return. Employers withhold the money because they're mandated to by the IRS.
So you can't get around it, can you?
You can't get around it, so don't think you can. So
what happens if you don't have the extra 20% to roll over the entire distribution amount? So
gotcha.
There we go, right? So for example, let's say you have $100,000 to roll over. And your employer is going to hold 20%, which means you now have 80,000 you have to roll over. But what happens when you can't come up with the remaining 20,000 needed?
It automatically becomes a distribution and you're going to pay taxes on that 20,000 that you can't put back into your IRA. Okay. And this is taxed as ordinary income.
Ouch.
Yeah. And if you can't come up with that 20,000 from the withheld funds and they're under age 59 and a half, Michelle, you're also going to pay the 10% early distribution penalty on the amount not returned, which equals out to a $2,000 penalty to you.
Yeah. So that's in using the example that I gave with this. Okay. So you're going to pay, if you can't come up with that 20,000, you're going to pay the 10% penalty, which is 2,000.
You got it.
And you're also going to have to pay taxes on that 20,000, and it's going to be taxed as ordinary income.
Yeah, that's correct. And I want to back it up real quick because I mentioned earlier a rule for indirect rollovers is you have 60 days to roll over the check.
Calendar days.
Calendar days. Oh, yeah. I keep saying calendar days. If you don't cash the check in under 60 calendar days and you're under 59 and a half, you've got to pay that 10% penalty. Also, if you roll over a traditional 401k into a Roth IRA, you still have to pay the taxes on the conversion to the Roth IRA because the traditional 401k was made up of pre-tax dollars.
Okay.
And don't forget that 60-day calendar day rule from the date the transaction actually started.
This adds up a lot, which is why we're doing the video, because if you don't know what you're doing ahead of time, the wrong type of rollover or making a mistake can put a serious dent in your retirement savings. I mean, this can be a lot of money.
Yes, it can be, especially if you're under age 59 and a half. But if you're over 59 and a half, that's a little bit different story.
Sure.
When you turn 59 and a half, rule states that you can withdraw or take distributions from your 401k without a penalty, but you're still going to have to pay taxes on if you're rolling over to a traditional 401k. But there's a caveat here. It's called the 55 and separated from service rule. As I've said, any withdrawals prior to age 59 and a half would receive a 10% early withdrawal penalty from the IRS. But if you meet the requirements of the 55 and separated from service rule, you still have to pay the taxes, but the penalty is waived. That's huge.
It is huge. And this rule only kicks in if you don't roll over the money from your old 401k, correct?
That's right. And this is the big mistake that I was talking about. If you're over the age of 55, but under 59 and a half, and you roll your old 401k to an IRA, the 55 and separated from service rule no longer applies to you. This is why I'm telling some people to leave their funds in the old 401k until you pass the 59 and a half mark, even just a little bit of them. Leave them there because you never know when you might need access to these funds.
Right. And while you don't really want to tap into your retirement, if something does go wrong and you need it,
there's your
why not
emergency
keep
fund.
it there so you don't have to pay, Peter, Paul, and Mary?
Yeah, and we talk about emergency funds all the time. Use that as your emergency fund as a last resort.
Okay. All right. So I want to go back to something that you said earlier. If you do an indirect rollover of a traditional 401k into a Roth IRA, you still have to pay taxes on the conversion. But what about if you're rolling it from a Roth 401k to a Roth IRA?
You have the exact same guidelines as any other indirect rollover, which includes the plan administrator withholding that 20% for IRS, the 60 calendar day rule, and also the penalties for not meeting these rules if you're under age 59 and a half.
Okay.
But with two exceptions, the 5-year Roth rule and the fact that your contributions are always yours, free of taxes and penalties.
Got it.
Here's where the 5-year rule comes into play. When you go to take out earnings from your Roth IRA, how long have you had that Roth? Is it more than 5 years and you're over age 59 and a half? There's no taxes or penalties for keeping your gains. But if you're under that 5-year rules, you will pay taxes and penalties on these gains.
So the key is to hold it for 5 years, the Roth.
5 years and 59 and a half. When you do an indirect rollover from your Roth 401k to a Roth IRA, you must have held the Roth IRA account for the 5 years. If you just open one to accept the Roth 401k rollover funds, the 5-year rule starts the day the first contribution goes into this account, no matter what age you are. Okay. That's why I always recommend the direct rollover option.
All right. Well, let's talk about direct rollover. It is a lot simpler than the indirect, but break it down for us.
Yeah, it is. Direct rollover means that you're taking your 401k directly to another company. A direct rollover is going from one to another 401k plan or going directly from your old workplace 401k to a traditional IRA that's in your name.
Okay.
This is also called a trustee to trustee transfer. And direct means you're not touching the funds. The check is directly written to the new company.
So it's going custodian to custodian. The money never comes to you. You don't get a check. It's not directly deposited in your bank account. It goes directly to the next custodian.
Yeah, this is what happens in most cases. You got some companies that require the check to be written to the new company and you at the same time. So let's say you went from Goodyear 401k plan, as an example, to TD Ameritrade as your new IRA custodian. Goodyear may require the check to be written in your name and TD Ameritrade's name and be like TD Ameritrade for the benefit of your name, right?
Okay,
on the check. But when they physically mail the check to you, the consumer, then you have to send the check to TD Ameritrade. You don't cash the check, so it's still not considered an indirect rollover.
Okay, so what's the time frame on forwarding the check? Is it still our 60-day calendar rule?
No, it's different because you're going direct. There's no time frame unless the check gives a specific time frame, like this check is good for 90 days as long as you don't cash the check.
Got it. Okay, makes sense. And also, don't cash that check.
Don't cash it.
We have just gone through what it will actually cost you. Be very, very careful on that one.
Or go watch our video that says, if you cash the check, this is what happens.
Exactly. It's not pretty, especially. All right. Yeah. Here's the thing. If you like the content of this video, hit the like button, subscribe, leave a comment below. Let us know your thoughts. Are you planning on doing a rollover? And I don't know. Let us know. Give us some feedback. Also, there are major 401k changes for 2023 that you need to know about. So I'm assuming if you're watching this video, you have a 401k. We're going to drop the video link in the description and the pinned comment below. Check that out because these rules are critical to how you plan and save for retirement. All right, Brian. So is there anything else you want to add before we wrap this up?
If you can do it, it makes sense to do the direct rollover in these situations so as not to create the tax or penalty implications that we discussed today.
It's also less of a headache.
It is. It's simpler, a lot simpler.
Yeah. And also, I don't know about you, but I personally wouldn't want a giant check coming to me in the mail. It seems a little risky these days.
Can I set something on that one right there?
Absolutely.
Do you realize, Michelle, that it really infuriates me because I see these rollovers and these companies require that the checks be sent to the consumer, right? And the consumer has to mail them in. Do you realize they send them checks regular mail?
No, I didn't.
But $250,000 check by regular mail.
Makes sense.
As a fiduciary, I'm required by law, anything over $25,000 has to be overnighted with tracking.
But they just send it out like it's a postcard to your grandma on your vacation.
And hopefully it gets there. Are you kidding me? Just saying. One of my pet peeves.
Listen, we really hope you enjoyed this video or you got a lot out of it. If you did, hit that like button, help us grow this channel. Don't forget to subscribe. Thank you, Brian, for this. And thanks to everybody who watched.
Thanks, everyone. Have a great day.